When most startups kick off and look for that first infusion of capital, that first round of funding, they might not be too selective on who they're choosing to be with them in that boat, in that venture, in that journey. Today, I'm going to talk about the difference between angel investors, venture capitalists, and what you need to know about both of them if you're going to raise money for your startup for the first time. Are you ready? Let's begin. Hi everyone, my name is Avishai, and today I'm going to be talking to you about the differences between angel investors and venture capitalist firms. So one of the first things you want to be mindful of is where the money comes from. Angel investors and venture capitalists have a very different source of where they're bringing the money from. When we're talking about angel investors, such as myself, most of the time you're going to see CEOs of current companies or ones that had a company in the past and had an exit. They're founders, they're entrepreneurs. They might be a management team of a bigger startup. They might have had a company that IPO'd. Angel investors will usually be from the entrepreneurial spectrum of the business world. They will be company creators, they will be value creators, and most of the time they're going to be investing from money they made on their own throughout their career. And because of that, you can't expect them to invest blindly into your startup because that money is money they worked really hard for, and they are usually very picky when they invest in startups in early stages. VCs have a very different source of funding. VCs use limited partners, LPs. Now, the VCs use different kind of LPs. It can be family offices that write a large check, or it can be even a pension fund of the teachers of Chicago or the firefighters of San Francisco. A VC will usually target a specific rate of return, and because of that, they have to kind of communicate to their LPs why they're investing in a company and the rationale, and when can the VC expect to see any kind of liquidation event from investing in a startup. If a VC fund has a target date or all kinds of limitations according to the personality of the fund, then sometimes they will give up on investing in some rounds. Angel investors have much more flexibility, and usually when they invest, they're not really in a hurry to see a liquidation event. Angel investors usually have a longer horizon and more patience in compared to a VC, which will usually want to see a startup growing really fast, and they're going to push the startup to a hyper growth mode as fast as possible, just so the startup can either reach the next round or reach some kind of liquidation event for the VC faster. Now, you're not going to find many angel investors investing in later stage rounds. They're not going to be investing in A round, B round, or C round most of the time. They're going to be investing in early stage. We're calling these rounds usually pre-seed, seed stage rounds. At an early stage, a startup might have a small amount of clients and even a little bit of revenue, just to show that there is a client base for the idea and that there is traction that can be created once the company reaches a later stage and takes a bigger round. Another thing that differentiates angel investors from VCs is that when an angel investor usually joins, they're not looking for what is called a board seat. They're not looking to be very influential in terms of the company's decisions. It's an early stage, and a angel on a board might cause the company unnecessary bureaucracy. VCs that have a lot more money to put in the startup and have a lot more money in stake that they're representing for their LPs might want a board seat at the company if they're investing a lot of money in it. So that's another differentiation between angels and VCs. Until now, I only talked about the different things between angels and VCs, but there are some things that are kind of not unique to any one of them. And one of those things, gladly for a startup founder, is that an angel and a VC will always, at least technically, be on your side and have the best interest for your startup. They'll be looking to help you and to bring value to the table. Now, yes, there are some angels that are less active and there are some VCs that are less helpful, but in general, an angel or a VC will want to help you grow your business, and they will usually be receptive to any kind of requests that come along from you as a startup founder. So as a startup founder, when you're kind of in that debate between an angel or a VC, somewhere between the seed and the round A stage, you might need to ask yourself, what kind of value do I want to have in addition to the money that's being infused in my startup? And when you're looking for angels in earlier stages or VCs and later, you want to be asking yourself, who are the partners around me, and do I see myself running with them in the long run? Now back to the differences. What type of check can you expect from an angel investor, and what type of check can you expect from a VC? Angel investors will usually invest anywhere between $10,000 all the way up to $100,000. Some angel investors will invest checks of $250,000, but usually those angel investors will be on a status of a super angel. Now, VCs will usually look to write bigger checks. If you're looking for smaller checks, VCs might not be interested in what you have to offer them as a startup founder. VCs usually don't like to put all the wheels in motion in terms of legal and their team of analysts if it's a small check. So this is a huge difference between angels and VCs, the size of the checks, and you can also sometimes get a lot of small checks from many angels, or you can get a few checks from a small amount of VCs, and you can play with it however you want when you're going for a funding round. I specifically sometimes write very small checks as part of angel syndicates, which allow a group of angels to invest as if they were a VC of a sort. So that is something that also exists. So angels, angel syndicates, VCs, these are options that you can approach as a startup founder. Now, here are a few tips for you as a startup founder before you're approaching any kind of angel or any kind of VC. If you're approaching an angel, you want to do your background check and to kind of look what the angel is known for. What is his core competences? An angel might ask you, why are you approaching me? What do you want from me besides of my money? And if you don't have a good answer for that angel investor, you might not get the check you're looking for. VCs, it's important to look what that kind of fund is specializing in, which kind of startups they already invested in. And if you see that you kind of fit the fund, then usually it's a good sign to approach. But if your startup is in a category that's very different from a specific fund you're looking at, you might want to reconsider approaching that fund. Here's a subjective tip that I'm giving you, and you can decide to follow it or not. At any point, if you're looking for under $1 million, do not go the VC route. It will be time consuming and it might be frustrating. If you're looking for more than $1 million, yes, VC should be an option on your table, but under $1 million, try to figure out what kind of puzzle you can build from angel investors that can actually help propel your startup forward. I hope you guys found this video useful. If you did, hit that like button. And if you want to follow more content in the world of business, startups, entrepreneurship, public companies, stocks, crypto, just hit that subscribe button, hit the bell for notifications, and I will see you again in one of my next videos. Thanks for watching. See you next time.